The NASDAQ market is closed today, Saturday, October 25, 2025. The last reported closing price for SoFi Technologies Inc. (SoFi) was $29.01 at 4 p.m. GMT-4 on Friday, October 24, 2025, which represented a strong plus 3.31%, plus 0.93 move for the day, with after-hours trading ticking up slightly to $29.08. That significant Friday bump, closing over 3% higher, is the immediate focus, and it's an expectation-exceeding event that many investors might simply chalk up to a general positive fintech market trend, especially with softer consumer price index data boosting rate cut expectations in the broader market narrative. But the deeper reality for SoFi stock is that the volatility is less about macro tailwinds lifting all boats and more about a calculated pre-earnings positioning by institutional players who are betting heavily on the sustained growth of the company's technology platform segment, a crucial and often undervalued pillar of the business that fundamentally changes the risk profile from a pure lender to a diversified financial tech powerhouse. This pre-earnings momentum is the real narrative here. The market isn't just reacting to rate cut hopes, it's specifically buying into the recurring revenue and bank charter leverage that the full-stack model of SoFi Invest, SoFi Money, and its lending products provide, especially as we head into their Q3 earnings report on Tuesday, October 28th. The general belief about SoFi is that it's a high-growth, high-volatility fintech stock whose performance is tethered to the student loan refinancing market and interest rate environment. This belief isn't wrong, but it's incomplete and dangerously short-sighted. The company's story today is less about student loans and more about its strategic shift into a low-cost, digital-first banking model. The reality that challenges this common ground is the outsized growth and focus on its Galileo technology platform, the backbone for other fintechs, and the dramatic success of its financial services segment, encompassing everything from basic banking to SoFi Invest offerings like self-investing tools, stock trading, and its intelligent portfolio robo-advisor services. In the second quarter of 2025, the financial services and technology platform segments together made up over half of total revenue growth, a substantial shift towards capital-light, high-margin, fee-based income. This diversification reduces their reliance on the lending cycle, making the company far more durable than its reputation as a student lender suggests. When you compare this full-stack approach to a pure-play retail brokerage like Robinhood or even a more traditional financial giant dipping its toes into digital like Fidelity, SoFi's distinct advantage is having the bank charter to hold deposits, drastically lowering its cost of capital compared to its non-bank fintech competitors. Looking at the recent stock movement, the nearly 4% pop on Friday was significant, and it came on moderate to heavy volume of around 46.5 million shares, which is not unusual for this ticker, but certainly suggests conviction ahead of the next earnings announcement. That move pushed the stock past a short-term resistance level, maintaining the aggressive uptrend it's been on since the beginning of the year, which has seen it rally by over 120%. That rally is the market finally appreciating the consistent string of quarterly earnings beats and the company's continuous guidance raises. Since Q4 2024, SoFi has not only met but substantially beaten consensus EPS estimates, converting what were once large losses into solid profits. For the upcoming Q3 report, the consensus EPS forecast is a modest $0.08, but the market's current bullishness suggests some institutional buyers are pricing in another beat, possibly anticipating a continued ramp-up in the highly profitable personal loan segment, which has been a stellar performer. Additionally, the institutional activity remains net positive, with more institutions increasing positions than decreasing them in the last reported quarter, which provides a strong bedrock for the share price. However, a crucial tension point is the continued insider selling. Key executives have sold shares numerous times in the past 6 months. While some of this is compensation-related, consistent insider sales at elevated prices can always dampen retail sentiment regardless of strong fundamentals. The core of what SoFi Technologies Inc. does is build a full-suite financial platform. It started with student loan refinancing and has systematically layered on products and services to become a one-stop-shop digital bank. Their business is fundamentally split into 3 key segments: lending, which includes student, personal, and home loans; technology platform, powered by Galileo, which allows other companies to offer digital banking services and is a vital B2B revenue source; and financial services, which is the consumer-facing suite of products like SoFi Invest for stocks and Fidelity ETFs, cash management, credit cards, and intelligent portfolio options. The goal is to move beyond mere transactions to become the primary financial institution for their target member base: young, high-earning, and financially savvy individuals. By adding new members at a pace that is now over 30% year-over-year and cross-selling them into multiple products, they're capitalizing on the network effect of their platform. They are a direct competitor to new-age digital financial services, and while interactive brokers might offer a more powerful trading platform for the sophisticated user, SoFi's strength lies in its ecosystem integration and accessible interface, much like what made Robinhood so popular initially, but with the added stability and regulatory advantage of being a nationally chartered bank. Their banking charter, acquired in 2022, is the ultimate advantage, allowing them to fund their loan book with low-cost member deposits instead of more expensive wholesale funding markets, which directly pads the net interest margin. Looking ahead, the tension between expectations and reality becomes razor-sharp with the Q3 earnings on the horizon. The market expectation is for another slight profit beat and solid member and product growth. The reality that could truly launch the stock higher, exceeding expectations, is a meaningful raise in full-year guidance tied specifically to the scaling of the Galileo and Technesis, a bank core technology businesses. An acceleration in non-lending revenue growth would cement the transformation narrative. Potential catalysts include a significant new partnership announcement for Galileo or another substantial securitization deal for their personal loans, which would signal sustained demand and high credit quality. The biggest risk, on the other hand, is a miss in the lending segment's performance due to a deterioration in credit quality from an economic slowdown. Given that their personal loan portfolio has become a massive growth driver, any sign of rising delinquencies would spook the market. Furthermore, competitive pressure from established giants like Fidelity Investments or new digital offerings from major banks cannot be ignored. The company also has a relatively high price-to-earnings ratio, which reflects a significant growth premium. If growth slows even marginally, that multiple will contract aggressively. The path forward for SoFi is less about simply acquiring new members and more about effectively getting their existing 11.7 million members to adopt more of the platform's 17.1 million products. The true long-term value in a financial ecosystem play is the average number of products per customer and the ability of that ecosystem to eventually displace traditional individual brokerage accounts and legacy banking relationships. This is the ultimate test of their model. Can they continue to grow the wallet share of their high-value members? Comment below and tell me, do you think SoFi's technology platform revenue will eventually surpass its lending revenue, and if so, when? The narrative hinges on that diversification proving its worth, and investors need to keep a laser focus on the fee-based revenue line items in the upcoming report. If the technology platform revenue continues its climb and the financial services segment gains traction in high-value products like mortgages and active online investment accounts, the expectation of a volatile growth stock will be replaced by the reality of a stable, diversified digital financial giant that can weather any rate cycle. Financial disclaimer. This video is for educational and informative purposes only and should not be considered financial advice. Always conduct your own research or consult with a licensed financial advisor before making investment decisions. Like, comment, and subscribe reminder. If you found this video helpful, don't forget to like, comment, and subscribe to stay updated with more stock market insights and daily analysis.